price volume buzzers as well. Anand Tandon joins us on the show to talk to us about fundamentals of a lot of these sectors, stocks, as well as the market which is in focus. Anand, let's begin by discussing the market itself, right? What do you think could be the next trigger for the markets? Because we hit that mark of 22,500. From there, we have cooled off, clearly lacking the triggers. Yes, we are waiting back for the macro data in terms of CPI, IIP, inflation, etc. But what do you think could materially move the needle?
The earnings. I think, frankly, the market has run ahead, way ahead of the earnings, so the market should be at. And the valuations are no more supportive now, unless and until there is something which dramatically alters that scenario. The market doesn't necessarily have legs to move up very far from here. That doesn't mean it can't go back to its previous peak or even a little higher than that. But that's only a 2 or 3% move. For a sustained move, you might finally need to have the earnings catching up. Right now, the market has gone up in anticipation that the earnings will be good. This quarter, if you look at the numbers that have come through, there have actually been more downgrades than upgrades. So finally, the analysts had turned far too bullish, and now they're having to tone down. So that itself will put a little bit of a cap in terms of how much the market can go.
Yeah, and clearly that earnings is something which is putting a cap in the market's mood right now. But what's holding out is clearly IT. Anand, you look at a TCS, you look at a LTIMindtree, Infosys, and for the last couple of days when the market has been a bit soft, IT has been doing okay. Time now to relook the portfolio and start allocating afresh to IT?
I would read the market more as saying that the momentum has been broken at least for the near term, and therefore move back into more defensive areas, and therefore perhaps a bit of give up on PSUs, defense, railways, and so on, which have led the recent rally, and instead of move back to things like private sector banks, FMCG, IT, and pharma. So, and if you see, some of those are the kind of sectors that have shown a little bit of strength. So I don't read it as something where you're saying that there is something exciting going on in those sectors. It's just that if you have to be in the market, you have to rotate out of those which have moved up too much. So what do you buy? You buy those which haven't performed so much.
Okay, so a bit of a sector churn at play. But Kunal, what about the IT pack? What are your top bets within that?
The two stocks which you mentioned, TCS and L&T and Infotech Mindtree, both of them are completely distinct charts for themselves. So, TCS is perched at a fresh high for itself. It's crossed about that 4,150 barrier. It's a flag formation, the classic flag formation breakout for TCS, which indicates that the stock should see a good upside, at least for the near term, unless, the IT pack goes into a very sharp kind of a reversal for itself, which doesn't looks like that it's going to be the case over the near term. L&T Infotech Mindtree is one of the stocks which was actually beaten down significantly. The stock had come back towards its major swing lows. I think, if I'm not wrong, L&T Infotech Mindtree has also come back towards its 200 moving average, completing a major retracement from 5,600 plus levels, now 5,150, 200 odd mark for itself. The hammer pattern, which is being formed on the candlestick pattern for L&T Infotech Mindtree, is the more distinct part about the charts over the very, very short term. So, which means that the mean reversion towards the 200 DMA, formation of a bullish hammer pattern, and the comeback from large cap IT names like TCS indicates that maybe we could now be at a cusp where many of these underperforming mid cap IT stocks should see a good bounce. My expectation is that L&T Infotech Mindtree from current levels should see at least 150 to 200 point bounce over the near term.
Okay, that's the take coming in on some of the other buzzers in trade. Balkrishna Industries, India Mart, AB Capital, IGL. It's an interesting bunch of movers out there from within the broader end of the markets. But just wanted to understand right now, Anand, what exactly is your take on whether or not you're looking at increasing allocations anywhere between, within the large caps, and anything that is a preferred bet here?
I would think that right now, for someone fully invested, you should be reducing equity allocation, and that's the first point. But within that, obviously, the small and mid cap had done too much and had even become more expensive than the large cap. So obviously, one needed to move out to the large cap and out of the smaller cap. As I mentioned, among the large caps, the defensives are the one that you can be hiding under. But if you really want to make money, you have to figure out something which is going to, actually change for the upside. Now, the only trigger I can see is a global trigger, which is that the dollar has started to go up, and it is very likely that around May or June, you will find that the interest rates in the US also take a first cut. No matter how much they talk about independent Fed, the fact of the matter is every time you go into the election, the Fed becomes supportive of the market and interest rates are cut. Now, in that kind of scenario, you have to assume that all the non-dollar trades, I mean, counter to dollar trade, which is things like precious metals, things like crypto, things like oil and gas, are the ones that will benefit because they're all traded in the form of dollars. So I would argue that if you are looking for a significant upside from here, or at least a trading buy, those are the sectors that you might want to look at.
Right. Okay, Anand, stay with us. Lots more to talk about, but let's
Infrastructure is clearly seeing a lot of boom. What's the best way to play it? Is it the road developers? Is it the cement play? What's the best way to play this entire infrastructure theme?
That's too wide a subject to be able to answer in a short thing. As you mentioned, you could play cement, but there is huge capacity that has come up in cement. As a consequence, capacity utilization has fallen and prices are again having to come back. If you are looking at the infrastructure players, they are already priced as if they will continue to get this kind of order book, and just increase in order book is not going to translate into higher top line anytime soon because they are pretty much at capacity. The banks obviously are also stretched in terms of the loans that they're giving. The credit to deposit ratio has now exceeded 80. So now it is going to be difficult for them to also push up the amount of money that they can lend. So there is no single way of playing it. Maybe the machinery sector is something that can continue to do well. But overall, from a perspective of the market, I think all the sectors that are directly related to infrastructure are already very heavily priced and discounting much of the upside. One should not be looking at discounting, double or triple discounting, as in saying that, okay, here's the spend from the government, here's the order book increase, here is this order book translating into sales, and then the sales translating into the bottom line. These are all the same thing. You cannot be discounting 4 times that in terms of the price. The market pretty much is discounting 2 or 3 times that anyway.
Sure, makes sense. That's the,
Coming in from our technical experts. But Anand, if I had to ask you one stock idea, one big theme that you are watching out for, not as a BTSC trade, but at least a medium-term trade, what comes to mind?
Well, like I told you, I think if you're looking at the targets near term, you should be looking at the international market. And that is where I think your triggers will come, as well as probably the investment ideas. At this stage, I'm very bullish on Japan.
Coming in on that note,